Hello, welcome to the Unit 6 Session 1 of our Financial Modeling course. In this session, we are going to consider characterizing risk, as the whole unit is about volatility models, while the Session 1 is focusing on the characterizing of risk. By the end of this session, you should be able to do the following. You should be able to relate risk and returns as opposite sides of the same coin. You should be able to explain risk in terms of the spread of the distribution of returns, state the proxies used in the finance literature to characterize volatility, and finally you should be able to explain the nature of distributions of returns in finance and why we need to go beyond the second moment to fully describe the risk our investments are exposed to. So I want to ask, why risk? Investing cannot escape risk because risk is simply a concept so central to the concept of finance, and that absent risk, the whole edifice of finance will collapse. A glance inside the financial pages of your local newspapers will toss out the word risk at the mention of return. This simply means that risk and returns goes hand in hand. That any investment with the prospect of returns comes also with the prospect or the possibility of risk. We don't limit ourselves to financial risk, as there are risks in this world. Even the concept or the very fact that we have life and there is a possibility of death also goes with the idea of risk and return, because life could be considered as a risk as return, while death could be considered as a risk, and no one knows when we will part ways. We are not going to limit ourselves to financial risk. So we see that when financial institutions have inadequate capital, they make huge losses on their trading activities, or their trading counterparties fail to honor their obligations, among many others. The consequences are mostly challenging. For instance, the Lehman Brothers, which were huge investment firms, failed catastrophically on September 15th as a result of some of these reasons, as in 2008. And as a result, this firm is no longer in existence because their assets were liquidated. So long-term capital management, such as hedge funds, which counted through Lovett among its advisors, collapsed in 1988 and nearly brought down the world finance system with it. Ashanti Goldfields, for instance, nearly collapsed when they entered into forward sales of gold in the derivative market in the late 1990s. Jerome Keviel, Kweku Adewale, and Nick Leeson are perhaps infamous in recent memories for having raked up huge losses at the trading desk in the Societe Generale case. What is common among these is simply the issue of risk. So then, what is risk? Risk is the variability of outcomes from the expected or planned levels. It is a measure of uncertainty an investor is willing and able to take in order to make a gain. In finance, we use the term volatility to describe this whole idea of risk. So, Chicago Board of Exchange, which is a huge derivative trading house in the United States, defines risk as a measure of the frequency and magnitude of price movement, both up and down, that the financial instrument experiences over a certain period of time. It further adds that the more dramatic the price swings in that instrument, the higher the level of volatility. So another way of viewing risk is to look at the variability of the returns from its mean. So figure 1 that we have here is a histogram of the Ghana Stock Exchange Composite Index. That is the mean return of the Ghana Stock Exchange Composite Index. The returns to the right of the vertical line, this portion, simply has to do with positive returns, and the ones to the negative simply has to do with negative returns. It could also simply means good news and bad news. We can have good risk and bad risk. That's outcomes can exceed our expectation, in which case we are happy, but it can also fall short of our expectation, in which case we will have issues. So as we earlier stated, that the issue of Lehman Brothers and among others, which also the issues of Enron, they are all issues of risk. And when we pass through risk, there's a tendency of either we are going to the firm or the investment is going to collapse altogether, or there's a chance of we reviving. But oftentimes, when we come across risk, there's a likelihood that we're going to fail, and we're going to fail a big time. So in this session, we have explained the concept of risk and return. We have explained risk in terms of the spread of the distribution of return. We have stated the proxies used in finance literature to characterize volatility and explain the nature of the distribution of returns in finance, and why we need to go beyond the second moment to fully describe the concept of risk and return. Thank you for your attention as we meet the end of our today's discussion. Hope to meet you once again in our next session.